joining the ranks of Meta and Amazon. It looks to me like another major tech company is going to be making a large number of layoffs, and that company is Alphabet. And so we're going to cover the potential for Alphabet to make a huge layoff and what it means for their valuation. So as you guys smash that like button, let me run that intro. What's up, guys? And let's get right into this one, because we were expecting for a couple of months now that Alphabet would announce layoffs. I haven't booked it into my numbers just yet, but I'm going to show you guys what the valuation looks like without those layoffs built in. I don't think it'll be super material, but it's very important as we sort of gauge the growth of these segments out. And so I'll disclose all of that in this video. But first, let's dive into the news. So it's reported that although Alphabet has thus far avoided mass layoffs, their employees are now worrying that their time might be coming. And so there's a large amount of growing anxiety internally that layoffs may be coming. And why is this? Well, you can see that recently there was a large shareholder of Alphabet by the name of TCI Fund Management that called on Alphabet to cut thousands of jobs and reduce spending on their long-term bets segment, or the other bets segment. And so what they're saying is that their company should be increasing repurchases, slow down spending in the other bets segment, and increase share repurchases. They're also saying that cost discipline needs to occur because they might be paying their employees too much. And so now that growth is slowing, or revenue growth is slowing, you need to pinch your purse strings a little bit more and rein in on that employee spending. And I don't think TCI's sentiment is wrong. However, it might be short-sighted because Alphabet is competing for these high-performing people against all other tech companies, and so you can't underpay them. They're gonna leave, and so be very careful when you start pinching people's salaries. And so I don't know how realistic that is, but I do think that it could be realistic that you slash some of your workforce, or you sort of combine certain groups to increase productivity. And that's exactly what Alphabet's CEO looks to be doing, because you can see here that earlier on, Sundar Pichai said that he aims for a 20% productivity gain. And what the way he's looking to achieve this is, in the past, the company merged overlapping product areas to boost efficiency. And so what that really means to me, and that was something that was reported on September 7th of this year, so way before even that November 16th article or statement by TCI. So what that tells me is that when you start merging these groups, you're going to have overlap. And when you have overlap, you have room to cut certain people that are just excess at this moment. And so I think that's how they're deciding who to cut within the organization. But that leads me to believe, just like how the internal employees at Alphabet are starting to believe, that there could potentially be cuts on the horizon. And this is why Forbes recently reported that due to pressure from an activist hedge fund, adverse market conditions, and a need to cut costs because of sort of like declining revenues, Google plans to ease out at least or approximately 10,000 employees through a type of stack ranking and performance improvement plan. And so what exactly does that mean? Well, it means that Google managers have been asked to rank 6% of their employees, which represents approximately 10,000 people, as low performers compared to the traditional 2%, according to the people who are providing this information. And it may just be rumor, so guys, just be careful with this type of reporting. It may be bull, but Google may follow in the trend of other tech companies and downsize, and it currently looks to be approximately 6% of the workforce. Well, what does downsizing look like in this environment? Well, you can see here that these are the tech layoffs that have occurred so far in 2022. And notice that the arrow is going up and to the right. That's not what we want to be seeing. And of course, that coordinates with the stock market's arrow going down and to the right. But notice that November was actually the worst month for employees being laid off. And so what does this mean, or what does this sort of layoff picture look like relative to the last couple of years, actually? Well, you can see that the layoffs haven't been this high since right before COVID, or right as COVID was happening, where a lot of people were laying off because we thought the economy was going to blow up. And so you can see that in Q4 of 2022, mind you, Q4 is not over. It's only November 28th as I'm recording this. So it's only been 2 months and not everything has been reported yet. We still have 1 more month to go. We're almost at that Q2 2020 number. I think a lot of companies could potentially even be waiting until the end of this year and do it in January. So I think January of 2023 or Q1 of 2023, if the economy is still moving in this direction, could be the worst month for layoffs. So it could absolutely be a bloodbath as we enter fiscal year 2023. Now, if Alphabet does lay off 10,000 people, it will join Meta and Amazon as the top 3 layoffs in the tech space in this environment. And so you can see some other names that have recently hit the wire. You see Twitter there. You see Cisco, which we're aware of. We obviously are aware of Peloton, Zillow, Crypto.com, ByteDance, which was a name that I didn't think that I'd see, but it is there. And then, of course, Carvana, which we are all very familiar with their layoffs. And so the question is, why is this happening? We know that revenue declined, but just to put this into perspective and just to remind you guys, in late October, Alphabet actually missed on earnings both on the top line and the bottom line. And recall, guys, that revenue at YouTube declined, and analysts were expecting growth of at least 3% at YouTube. Now, look, I'm doing the best that I can by putting out videos almost every day, but I really need Mr. Beast to step up and put more videos out and better videos out because I can't run this ship on my own. I need more content creators to make it so that YouTube's revenue goes back up and to the right. And so you guys need to get on Mr. Beast's case. And if you don't want to get on Mr. Beast's case, that's okay. Just drop a meow in that chat because it'll help with the YouTube algorithm and they'll send this video to more people. And thus there'll be more ad exposure and then more revenue for YouTube. We'll turn this ship around, guys. But I want to show you YouTube's or Alphabet's financial statements to just give you an idea of how I'm growing these businesses out in this environment. And so this is the historical information of their financial statements, just their P&L or just down to their revenue line. Now, this sheet might not look familiar to you. This is actually the model that the Patreons get access to at that lower tier. It's only $5 a month, but if you want to get access to all the models of all the companies that I'm following, you can get access to at that lower tier of just $5 a month. And if you want, you can join us on the Patreon on our monthly calls. And it's really informative. I learn a lot. You guys learn a lot. And so it's a lot of fun to jump on the call with you guys every month. And so if you want to join us there, you can. But notice here that Google search, I have highlighted in yellow, YouTube ads, and Google Cloud. These are all the segments. I forecast out the company's revenue on a granular basis, which is on a segment by segment level, which allows me to forecast this company out better. And notice that all three of Google search, YouTube ads, and Google Cloud, they all grew in 2021 by higher than 47% for that top line. Do you think that they're going to grow at that rate in this environment? I don't think so. And so I'll show you how I'm forecasting this out. Notice that I'm expecting a low double-digit reality, and I'm also being okay with a single-digit reality for growth. And so Google search, I'm only growing out at 10%. YouTube ads, I'm growing at 0% in fiscal year 2022, and then 10% for the next year and 15% thereafter. I'm really hoping that Mr. Beast gets his butt in shape in 2024 and drives this thing back up. And then Google Cloud, that's the one that's firing on all cylinders right now. And so I expect 2022 to end at 25% top line growth and then thereafter at 20%. But as you can imagine, because those segments are a little bit smaller and the big behemoth for Google is still their search product, notice that the search in 2022 is expected to generate $164 billion. It still makes up approximately 60% of the company's revenues. And so this is still a Google search based company. And so overall, because that's the slowest growing segment, the company's revenues as a whole are growing at 9.3% in fiscal year 2022, or at least that's what I'm forecasting, and then only in the low double digits thereafter. So what does this mean for the valuation as a whole, irrespective of how excited we are about Google Cloud? Well, you can see that based on a 17.5 times earnings multiple, which may actually be very low, I admit, it probably should be a 20 times multiple at the very least. And without any efficiencies being built in this environment, I'm not taking into account that 6% of efficiencies until it's publicly released. I am forecasting the company to be worth approximately $130 per share. And so when you compare that with their current share price of approximately $100 per share, this company is trading at approximately 75% of their intrinsic value. Mind you, I admittedly am using a low multiple. So you can argue that it's trading at a third of its intrinsic value. So maybe like 66 or 67%. And so this could be a name that you really want to add to your portfolio, because as Warren Buffett always says, it's better to pay a fair price for an exceptional company. And there's very few companies out there that are as exceptional as Alphabet. The one thing that I would want you guys to pay attention to, and it's something that TCI referred to, is pay attention to that stock-based compensation as a percentage of their revenue. So if you're going to forecast out this company using free cash flows, make sure that you make a deduction for that stock-based compensation line. Otherwise, you might be overvaluing the company. So just a hint. And if you want to see how that's done, take a look at the model that the Patreons get access to at that lower tier and see how I did it. It's a really good learning example. Now, if you missed the complete walkthrough of Alphabet's recently quarterly results, I highly recommend that you review that video, because it's chock full of information that will really help you understand how to think about this company going forward. And if you missed that video, no problem. I have it linked right here.